Talk Chapter 3. Chapter 3 is all about taxes. Is kind of what the concept is. You can learn some information about how to file your taxes, just some very basics. This is not by any means an in-depth tax class, but there is everybody should be aware of some basic tax concepts and strategies just as they go about their day-to-day lives, so that as you begin to earn more throughout your lifetime, you're aware of and can take advantage of strategies to reduce your tax bill, of course, legally within the tax laws that currently exist and will exist in the future. So that's really what the point of this slide is kind of telling you in red there, about minimizing legally your tax burden, how much you'll have to pay. That's the key part, of course, is doing that legally. So really just want to be aware of some of those concepts, what deductions are, what credits are, what goes into your computing your taxable income that will then be used to compute your tax bill each year. And just with every chapter, it has the financial facts or fantasies. I'll let you look at those on your own. And so just kind of a little bit of setup about the tax code, the way it is now. And of course, for those of you who might be taking the class in accounting, you're very aware the tax code changes year to year. There's some basics that really haven't changed for a very long time, but just know that the tax laws change every year to some degree in terms of deductions and different tax rates, things like that. But there's some very basic concepts that never really change. They're always the same. So we'll talk about what those are and what they mean. So right here it says that typically a family pays about 1/3 of your gross income to tax, and that's all levels of tax from local government up to the federal government, and that includes what's withheld from your paycheck for Social Security, Medicare, state income taxes, property taxes, sales taxes, and federal income tax. In South Dakota, you'll be paying sales tax for sure. If you own property, you'll be paying that. We don't have a state income tax in South Dakota, but everybody, if you've got a paycheck, you're paying Social Security and Medicare tax. And of course, the goal is to minimize your tax burden legally, and there's certain things you can do to take advantage of tax law to make certain kinds of expenditures or investments that will ultimately in the future reduce your tax bill. About half of taxpayers pay no income tax because they earn less than the federal threshold for that to kick in. However, if you have a paycheck, everybody pays Social Security and Medicare tax, which is 7.65% of wages. So no matter who you are, 7.65% of your wages is taxed for Medicare and Social Security. Taxpayers with income over 250 file 2.4 of their tax returns and 48.9 of their income tax. So this last point I think is kind of important, and you always hear during political campaigns and things like that, everybody paying their fair share. And we've said here, right here, about half of taxpayers pay no income tax, just nothing at all. All they pay is Social Security and Medicare, which is really the government's just taking that, and what they're supposed to be doing is holding on to that to pay for your future Social Security and Medicaid benefits when you get older and retire. That's what the point of those is for. So the bottom point, taxpayers with income over $250,000 filed only 2.4% of all tax returns. However, they paid darn near half of all tax, 48.9%. So think about that. So almost half pay no tax at all. 2.4% of filers paid 48.9% of tax. So just something to ponder and think about. So tax computation is not complicated. What's complicated is coming down to what you're taxed at. What is your adjusted gross income? That's probably where it gets complicated. But once we know what your taxable income is, we multiply that by a rate times a base. Name of tax indicates the tax base. If that's property tax, the value of the property is the base. Sales tax, tax base is sales, etc. In South Dakota, we pay a city can charge up to 2%, and the state charges 4.5%. So when you go and buy something, you're taxed at 6.5% in Sioux Falls. If you were to buy something outside of a town, you might only pay 4.5%, but basically it's the rate times the sale. Lower tax by lowering tax rate or the tax base. Lower tax rate by nature of income. Capital gains and dividend taxes at minimum of 20% for gains up to $250,000 on a single or $500,000 from a joint filing. That's basically married people. Sale of a personal residence is taxed at a 0% rate. So if you sell your home, you're not taxed on that. So some taxes have different rates, and what they mean by the point here, lower tax rate by nature of income. Capital gains are taxed at an amount lower than just normal earnings. So certain types of income are taxed at different rates. Now these are tax rates that are older, even though this book has only been out for a year. These tax rates they've given us are older. And we'll just use kind of what they've given us. They'll give us the rates when you do the problems in Cengage, but just be aware that these are the rates. And so notice that we have a progressive tax, and progressive means the more you make, the more tax you pay. So that's why we said that people who made $250,000 or more, while they were only 2.4% of all tax filers, they paid almost half of all tax, because look at what the rate is. The rate becomes very high. And this is for single. And so you can see here, once we hit above the 89,000 number, we get the 89 to 186, you're at 28%. And then once you get to above 406, you're at 39.6%. So to compute the rates, you have to do it like this. It's a little bit different how you do this. So we're looking back at the rates from this slide here when they give us these examples. And it says taxpayer with taxable income of $36,900. So this is the taxable income. This is income after you've made deductions for exemptions and deductions, itemized deductions or standard deductions or anything like that. So this is the amount that's actually taxed. So just because you earn $1 doesn't mean all of it's taxed. You have to deduct from that your legal exemptions and legal deductions to get to the taxable income. So for 2014, the tax is right here, 10% times 9075, and we look at the rate go here. So 10% at 9075. And then 36.9, which is the next bracket. So the next bracket was 36.9 right here. And we subtract the 9075 times 15% because that was the next rate. So you're taxed up to 10% of your first 9,075. Then from 976 to 36.9, you're taxed at 15%. Okay, so that's how it's computed. So 5,081.25. And then for 2015, kind of the same deal. Just the tax rates you can see. The rates didn't change, just the amount of earnings subject to tax changed, which is pretty common, that they will change those every year a little bit based on inflation and things like that. So you can see the difference of 750 just based on a little bit more earnings for between 14 and 15. You can see what the tax difference was. Okay, so tax rates. So I've already mentioned that the tax rate for the federal income tax is progressive. So as income increases, the tax rate also increases, and so on, as we saw from that table. Sales taxes typically are flat, and they call that regressive. So basically, no matter what your income is, your sales tax rate is the same. So somebody who earns $20,000 a year versus $200,000 a year, both people would pay the exact same sales tax. That's why they call that a regressive rate. In South Dakota, almost everything is sales taxed. Except there's exceptions for things. Anything involving medicine or medical services is one item that's not sales tax, which makes sense. But almost everything else is. But if you go to other states, certain things are not subject to sales tax. So if you go to Minnesota, clothing is not subject to sales tax, and so it just depends. Different states have different ways of looking at it, but there's always every state's a little bit different with how they apply certain sales taxes. For planning purposes, tax rates are identified as either being your average rate, which is total tax divided by your taxable income, or what we call a marginal rate, which is basically the tax on the last or next dollar of taxable income, depending on if that extra dollar puts you into the next bracket that's a little bit higher, that has a higher earning. So average tax rate or marginal tax rate, just kind of make sure you know the difference between the two. They'll come up on a quiz or a test, and of course you need to know that from the homework. The filing status also determines how much tax you pay. There's basically 5 categories: single, which is unmarried; married, filing jointly, 2 people who are married filing a joint return. Most married couples do file a joint return. You can also do married filing separate, though, if you would like to. That's a possibility. Head of household is a single taxpayer who is basically providing benefits to some dependent person. Relative other than cousins typically is somebody that qualifies. So typically living in their household, although not necessarily, but somebody, you're providing benefits to somebody, and so you qualify for head of household status. And surviving spouse, which is for 2 years after the death of a spouse. You get the joint rate if you have dependent children living with you. So the government's trying to give you a little bit of a break for up to 2 years after a spouse passes. Take-home pay, I'm sure everybody knows what that is. Just pull out your last paycheck stub and take a look at it, and you'll know exactly what take-home pay is. You take a job, you accept a job, with getting paid a certain amount of money per hour, and then all of a sudden, you work. Let's just say you're making $10 an hour, and you work 10 hours a particular week. You make $100. We all know that we're not taking $100 home with us. We know that's not the way it works, because the government's basically said to businesses, you are tax collectors. And so businesses are withholding Social Security, Medicare, plus and other things too. Of course, they're withholding federal income tax. They're also withholding anything that the employee wants as an elective deduction, which would be retirement, insurance, maybe contributions to some charity, whatever that is. That's all coming out of your take-home pay. Capital gains, we kind of mentioned those already. There's 2 kinds of capital gains. They're taxed differently, so it is important to understand the difference between them. Long-term gains is when you own a property for more than a year, 12 months or more than 12 months, so 13 months or longer, 12 months and a day or longer. Once you sell that, then you've got a long-term capital gain. Short-term gains are from less than 12 months. Long-term gains qualify for a lower tax rate. Short-term gains are taxed as ordinary income. So whatever your normal tax rate is, based on the progressive tax table, you pay tax based on that. So long-term gains have different rates depending on what your tax bracket is. So if you are in a lower tax bracket, from the 10 to 15% tax bracket, and you have a long-term gain, you pay 0 capital gain tax. If you're in the 25 to 35 bracket, you pay a 15% capital gains tax. And if you're at 39.6% bracket, which is the highest one, you pay 20%. So the highest tax you'll pay for long-term is 20%. The vast majority of filers are going to be in that 15% range. Dividends are also taxed a little bit differently. Dividends from domestic U.S. corporations are taxed at a long-term capital gain rate. So if you own stock of a company and that company pays you a dividend, then you get to earn, you get to keep more of that money. Basically, you're taxed at the long-term capital gain rate. Capital losses can be used to offset capital gains. They're deductible to $3,000 per year, and thus if you have a $50,000 capital loss, it might take 17 years to deduct. That's okay. Corporations cannot deduct those. This is a personal finance class, but as individuals, if we have a capital loss, we can take $3,000 that loss per year for as long as it takes to get that loss off the books. There's 3 kinds of income that might limit your deductions. Active income is income basically from you working, essentially your personal services, a job. You have portfolio income, which is income from your investments. So if you've got an investment portfolio, you're buying some stocks, and you get gains, interest, dividends on that, that amount will limit deduction for investment interest. So essentially, if you borrow money to and then invest it, potentially you could deduct some of that interest you paid on that borrowing. Passive income is income from property not related to personal services. Loss from one passive investment may only be deductible against income from other passive investments, not deductible from active income. So as you earn income, you have to figure out, is it active, portfolio, or passive, because tax rates and then deductions are all affected by each one. The vast majority of people, the vast majority of their income is going to be active. That's really the number one. So taxable income is your gross income from whatever sources derived less amounts excluded by the Congress. Basically, Congress writes tax law, such as proceeds from life insurance, scholarships, gifts, interest on state and local tax bonds, and others. So not all income is taxable. Okay, there's a certain amounts of things you receive that will never be taxed. If you own a life insurance policy and you are beneficiary of that life insurance policy, so if somebody passes and you receive life insurance proceeds, it's not taxable. You get every dollar. There's no tax on that whatsoever. Scholarships, gifts you receive. If you buy a bond from a state and local government, it's not taxable. The interest is not taxable. So certain income is just not taxed at all. Not much, but there are certain things that are not taxed at all. You also have to subtract adjustments to your income, including business expenses, contributions to retirement funds, and other tax deductions, which Congress, of course, has approved. And then you get your AGI, called your adjusted gross income. So taxable income minus adjustments gets you to your AGI, adjusted gross income, and that's what you multiply by your tax rate to get your tax liability. Actually, I should say there's one more thing you get from, you have to keep going, I misspoke. So adjusted gross income minus what you see on the screen here, your personal exemptions and your deductions. So you get personal independent exemptions, so the more people living in your household that are dependent on you, the more exemptions you get, which reduces your adjusted gross income. Then also your deductions. So you can take either a standard or itemized deduction. If your itemized deductions are greater than your standard deduction, of course, you'll take your itemized. And that's, some common deductions include mortgage interest on your primary residence, certain medical things, property taxes, sales taxes. Those things are itemized deductions. There's lots of them. Depends on how much you're paying for mortgage or property tax. That might put you over the itemized, but basically if you have more itemized than standard, you take the itemized. Taxable income, apply tax rates at your tentative tax, and you have credits. So once you compute your taxable income, you may have credits which act as a payment. You get credits for child care, dependent care. There's some medical credits. There's credits for investments in certain technology if you have a hybrid vehicle or solar, or it's kind of whatever the government's trying to get people to do. Quite often they will allow for a credit to there, which reduces your tax burden. So an exemption is a reduction in taxable income. You can see here in 2015 it was $4,000. Of course, it'll go up a little bit every year. Each pair is a personal exemption plus 2 on a joint return, or thus 2 on a joint return. And then, of course, if you've got a qualifying child or qualifying relative, that will also come into play. And that is all based on age, residence, and support. You could do an entire couple of chapters from a tax book about figuring out what those are. It's not the case here. We just need to be aware of those. So your standard deduction, if it's greater, you deduct the greater of your standard or itemized. For standard, from 15 is the last dates they gave us here. For single, it's $6,300. For joint, it's just double that, $12,600. It's adjusted each year, so it'll be higher for 16, of course. Your itemized deductions, I've mentioned a few of those. Here's some really common ones. Medical expenses, if they're above 10% of your AGI, so if you had a really bad year for health, you and your family did, and you're paying a lot for medical care, you can deduct a certain amount of that. State tax, but only property and either income or sales tax. So in South Dakota, sales tax that you pay to the state and city in South Dakota can be deducted from your federal income tax. Interest on mortgage up to 2 personal residences with total principal of $1 million, plus interest on a home equity loan with principal up to $100,000. So that's the key thing about interest. You only deduct interest based on your personal residence. That's a very big one. And charitable contributions is another very large one too. As you get to the end of any year, you'll see all kinds of advertising, flyers, mailers coming out, emails from nonprofits saying, now is the time to deduct. Pay us now, write us a check. And actually, even if you use a credit card to pay a charity, as you did, if you did that in 16 or 17 or whatever the end of the year is, as long as it's based on when you made that payment to the charity, that counts. So you could put it on a credit card in 1 year and pay it off the next year, but you get the contribution deduction based on the year you did the credit card charge. So any amounts above 250, you have to have a letter from the organization basically stating that it was a deduction or a contribution with nothing received. So you can only deduct amounts that you give without receiving services. So if you go to a nonprofit and say, I'll give you $50 if you give me, something back, you cannot deduct that then. It just has to be purely, truly a gift, and that's it. And you can also include some business expenses above 2% of your AGI. And there's a whole list of deductions. And of course, we could do, if it was a tax class, there would be a couple of chapters just based on deductions. So tax credits are basically just reductions in tax. They act as payments, even though they're not a payment. Some common credits are $1,000 per dependent child. Education credits if you're taking in college. If you're as college students, your parents may be getting some credits, or you might be, depending on your tax status. Energy credits for investing in high efficiency furnaces, solar, child independent care credit, earned income credit. If you have income below a certain amount, you get a credit on your tax. That's why up to 50% of tax filers pay no federal income tax, because they qualify for the earned income credit, which means if your income is below a certain amount, you get this credit. And that credit, as I mentioned, it's treated as if it was a payment. So if you get the earned income credit, you might actually get a refund on that. The government might write you a check potentially. So taxes are pay as you go. When you get a job, you file a W-4 with your employer, and you're telling the employer what your status is, if you're single, married, head of household, whatever that is. And you're also telling the employer how many exemptions you get, if it's 1, 2, 3, 4, whatever the number is. And then your employer plugs that into some software when they do payroll, and then that will compute how much federal tax is taken out of your paycheck every time you're paid. Banks and the financial institutions must withhold tax from amounts they pay to taxpayers. So depending on if you're getting some kind of a payment from an investment, quite often they're going to withhold tax from that. Self-employed taxpayers having income that's subject to withholding must pay estimated tax on a quarterly basis. Tax refund is tax owed less withheld plus estimated tax paid. So if you do get a tax refund and you're thinking, wow, that's great, I got some money, you're just getting your own money back, by the way. So what that says, if you get a larger refund, you didn't do good tax planning. You let the government get too much of your money throughout the year. You're getting it back, which is great, but you're getting it back interest-free. The government's not paying you interest for keeping your money. So if you get a large refund every year, rethink what your withholdings are, your tax strategy a little bit, and try to keep more of your money on a monthly basis. So just something to keep in mind. But taxes are a pay-as-you-go. So every time you get a paycheck, taxes withheld. Just keep that in mind. So tax forms, there's all kinds of tax forms. Everyone can file a 1040. There's 1040A, 1040EZ. Every December, January, February, there'll be a bazillion ads on TV and everywhere you happen to catch any kind of media advertising telling you all about the different and various tax software available. H&R Block will start advertising. So there's lots of ways to get taxes done. Some people do it on their own after they buy software. Other people will, go somewhere and hire somebody, like an H&R Blocks or whoever it is, or go through a CPA or whoever it is. But there's lots of ways to do it, kind of depending on your level of income and how complex your earnings are, which should really help you to decide what to do. I will just tell everybody that if you've not made a lot of money, especially most of you here, clearly college students, and you haven't really got those high-paying jobs yet that you hope to get with your degree, an EZ probably is the way to go. You probably are very okay with that. But you need to talk to your parents too about did they claim you as a deduction. That's important to know as you go through and file your own taxes. So if you do it on your own, if your parents do it for you, or whatever the arrangement is, just know that just make sure you're aware of the so if you're not getting your itemized deduction or standard deduction, I should say, because your parents are claiming you, you have to keep that in mind. But there's all kinds of software you can use to get this done, and I've just kind of already mentioned a few of them. So commercial tax preparers, H&R Block's probably the most popular one. There's lots of chains that do taxes, CPA firms, lawyers who specialize in tax, what they call enrolled agents, basically people who are preparers that are enrolled and registered with the IRS. It means that they've done quite a bit of training, so they're a little bit better at taxes. They've got all the knowledge. So all taxpayers can do their own tax returns as well as change the oil in their cars, but many prefer to pay someone to do both, right? So it's not anything that somebody couldn't figure out how to do. However, quite often, if the older you get, the more complex your earnings are, as you have more exemptions, dependents, as you have more investments, retirement accounts, and so on, it probably makes sense to go the route of hiring a professional. At first you can probably do it on your own, but at some point a professional may help you find deductions that you weren't aware you could take, and so therefore it's kind of like an investment. Even though I'm going to pay them a few $100s to do my return, if they find enough deductions that I save more than that in tax, I'm coming out ahead. Plus, they can help you with strategies to minimize future tax payments. And that's what tax planning is about. Shifting income to later years, deductions to current year, income conversion, convert ordinary income into capital gain, different types of investments that you can do to help you do that. Dividends versus interest, what's taxable at what rates, state and local bonds, which are not taxed. So somebody who is well versed on tax strategy can definitely help you and guide you towards the certain investments that will result in less tax now and maybe push that off into future years potentially. So tax shelters are just simply anything that's legal that the government has set up as a way for you to invest your money and not be taxed, right? So example is ownership of real estate, right? Your primary residence. There's lots of benefits to owning your primary residence because the interest and the property tax you pay on that reduce your taxable income, right? So that's one reason to own your own home. The government's basically saying, we know it's good for people to own their own place, right? So we're going to give you some tax benefits by doing that. Lots of savings investments for retirement are tax shelters, and there's a reason for the government wants you to have a savings when you retire. If you've got plenty of money in your retirement accounts, you're in good shape. Okay, so tax audit, of course, the IRS is responsible for enforcing tax law. Returns are selected for audit based on probability of error in a random basis. And if you were to get audited, just keep calm, gather your records, and if you made an error, learn from it. I made an error one year. I got a letter saying you forgot to put something in, and no big deal. I just refiled, and actually I have a little bit of money back. So it's not a big deal. It's very easy to do. But just be aware of the tax strategies here. Very important. The chapter is really important for you to read this week for this particular chapter. There's a few pages or a few exhibits I want to mention that are really good for you to take a look at, to kind of give you some pictures of kind of to think through how taxes are calculated. Exhibit 3.1 gives you a really good picture of how you go from gross income all the way down to your tax liability. That's a really important one to understand. Exhibit 3.2 gives you a really good picture of capital gains tax categories. And throughout the chapter, there are several things that are shaded green, and there are financial planning tips. Those are really worth your time to read. The more time you put into that, the more that will help you in the future, just with your taxes and so on. So just make sure you read through those. Plus, the chapter includes all the different tax returns. It shows you pictures of them. And so when you take a look at those too, just so you know what the tax returns look like. Plus, you'll need to know what they look like to help you do some of the Cengage homework. So within the class in my.usf, I have posted 2 different tax returns. So I've got this open right here. So the 1040 return and the 1040 EZ, I've already got them open. They're just simply PDFs. So there's the EZ and there's the 1040. And again, you've got those already available to you within the chapter. You can see pictures of those too. So these are the returns that you would file to do your taxes. So you'll need to look at these when you do your homework in Cengage.